Welcome to the Monday edition of Dividend Cafe. We had a pretty interesting day today. I think there's a fair amount of things to cover in the news front and public policy. Not a super exciting day in markets, but we'll give a rundown of all of that and just cover our normal categories. And obviously, we welcome your questions anytime. I do want to direct any of you who may have missed the Friday Dividend Cafe to dividendcafe.com. As always, there's the full written report that I do each week. This week being my analysis of the One Big Beautiful Bill Act, the new tax and spending bill that has been signed into law by the president. There is obviously our video and podcast, which, if you're listening to this right now, it may be one of your chosen mediums. But either way, dividendcafe.com, Friday, thorough analysis of the One Big Beautiful Bill Act. As far as markets today, the Dow opened down about 80 points. It closed up about 80 points, 88 to be precise. So you had 20 basis points upside in the Dow today, 14 in the S&P, 14 basis points. And then the NASDAQ was up about 0.25%. So all three market indices up, but not by a ton. They had all opened down. And I think that's probably the thing I'll skip to quickly to go into in public policy, and then we'll come back to some of the other stuff. But I think it is essentially the biggest question of markets right now is the barrage of threats about tariffs and what is actually going to end up happening. And I think it's easy to say the markets have now decided tariffs are not a problem when the president says we're going to implement a 30% tariff as a baseline on Mexican imports, or a 30% baseline as a 30% tariff as a baseline on European imports, a 50% tariff on copper imports, and that markets are still either going up or not really responding. And that my view is that markets are not going up, or excuse me, not going down, because markets do not believe that these things are going to happen. I want to give a bit of numbers behind this. Um, to the extent that a baseline tariff of even 15 to 20% was to be implemented across the countries this has been threatened on, then you're talking about anywhere from, at 15%, about 500 billion, at 20%, about $650 billion of new taxes. That's a new tax cost to the economy that would have to be absorbed. And I, again, don't know that that will happen. I am very skeptical that it would. But the idea that if it did, it wouldn't have an impact to the economy and the markets is just ridiculous. That level of tariffs would essentially double the total taxes paid by businesses in America now. And so I think that you'd be looking at a significant cost, but you're not seeing a market response because the market doesn't believe that cost will end up happening in the end. Now, again, the 30% tariff being threatened on Mexico, very possible a deal ends up getting worked out that is outside of automobile tariffs. Same exact thing with Europe. Europe today announced that they are not going forward with any retaliatory tariffs because they are still optimistic and confident that a deal is going to get worked out in the next 2 weeks. The 50% tariff on copper imports, you do see an impact in copper prices. Copper has averaged somewhere around $4.75 a pound for most of the last several months. It's gone a little higher, a little lower, but that's been the median price, the mean price, $4.75, and it is pushed up to $5.50 a pound. That's over a 15% move in a few days. Copper is, of course, vitally important in semiconductors, construction, appliances, machinery, and all sorts of industrial and computer equipment. The main issue, I would say, even in housing, construction, etc., it is a kind of bizarre thing, in my opinion, because on one hand, this is not a national security or critical infrastructure risk. We make about 50% of our copper needs domestically as it is. So there's no sense in which we risk being reliant on a foreign adversary for copper. We have adequate domestic copper production, but we also do import a lot for price advantages and volume. Even though that isn't necessary for critical infrastructure, there is still a marginal price impact that is, for our commercial needs of copper that is clearly pushing upward prices on it. So either that is also another threat and negotiating tactic that is largely being ignored in equity and bond markets, or there will end up being a price to be paid later that I have no doubt would be significant. But this is the ongoing story of how markets are supposed to absorb policies that could be concerning to markets at face value. But if markets don't believe those policies will end up happening. And so we're going to see what kind of trade deals get announced in the next couple of weeks. The other public policy thing I want to get to while I'm here, and I'll go back and cover a few other basics in a moment, is that there are more and more whispers I'm seeing, including from some folks. The reason I'm actually covering it today in the Dividend Cafe is because some of the people talking about it are people I respect enough and trust enough that I think there is some legs to it, of a possibility of a second reconciliation bill being pursued in the Senate this year, to essentially now get a different swing of the bat at potentially some greater spending reductions, some greater deficit reduction, and some additional tax reform. Now, there is no accompaniment with these murmurs, whisperings, what have you, of any specifics, of any actual, even theoretical particulars as to where this could go. But there is a political pressure. Senator Johnson, Wisconsin, Ron Johnson is pushing it. But when I hear Majority Leader Thune taking up the mantle, and again, others that I'm talking to that are my sources on the Hill, I think it's something I'd be curious to watch. And obviously, if a second bill were to come that does better address deficit reduction than the first bill did, I would view that as a positive. Some of the news stuff I want to cover is just the obvious shift in the president's posture about Ukraine. They announced this morning they're ramping up missiles that will be providing Ukraine through NATO. The president's articulating his own frustrations of Vladimir Putin much more clearly now. Trust me that China has to play a big role in where this is going. And when they're talking about now imposing tariffs on those that do sell Russia oil, or sanctions on those that sell Russia oil, as a way of putting more teeth into the sanctions that are on Russia, there is some leverage now that is being used, or at least talked about, that could make a difference. On the market front, I mentioned how markets all closed today. I just wanted to reiterate that earnings season is starting tomorrow. We'll have a barrage of financial companies announcing Q2 results in the days ahead. And then you're going to have a lot of focus, as it should be, on what they say about Q3, about Q4, about forward guidance. I'm particularly curious in the financial sector, where they anticipate some M&A activity. There is a pretty solid movement afoot for deregulation. And are we seeing more corporate finance activity taking place that would be a driver of growth? We're going to be watching for that. Obviously, the media wouldn't let us not watch for the update in AI CapEx. That'll be a big discussion, more a couple weeks out in earnings season. And then obviously where companies are addressing tariffs and the uncertainty around tariffs, where that may or may not be impacting activity, price levels, and obviously plans for hiring. So those are kind of the major themes we'll be looking to during earnings season. The top 10 companies in the S&P 500, which is obviously not 10%, 10 companies in the S&P 500 make up, 10 divided by 500 is 2% of the companies in the S&P 500 are now an all-time record high, 40% of the S&P 500's market cap. The delta, there's a chart at dividendcafe.com the delta between the weighting of these 10 companies and their contribution to earnings is staggering. Now, they have a very large and disproportionate contribution to earnings, but how the level of their cap weighting and their earnings has uh, kind of grown apart here in the last 5 to 7 years is remarkable. I encourage you to check out that chart. Nvidia is at a $4 trillion market cap. 4 trillion is a big number, but I think that the 3.6% of global GDP that represents is the bigger story. And a hat tip to my friend Peter Bookvar pointing out that Cisco at its peak in 1999 was 1.6% of global GDP right before it ended up going down, 80%. Nvidia right now is 3.6% of global GDP. Huge success story for Nvidia. Huge thing for investors to understand. Is the Mag 7 unstoppable? Well, it's down 3.5% since December. So yes, there's some names in Mag 7 that have had a big comeback here in June. But keep in mind, Apple's down 15% year to date. Tesla's down 22% year to date. Google's down 5% year to date. So as a group, Mag 7 is down 3.5%, even as the market is up quite a bit. That speaks to that story changing, and it also speaks to a decorrelation amongst the names within Mag 7. We have the CPI number for June coming tomorrow morning, the PPI number coming on Wednesday. There is intensifying drama around the Fed. It appears to me they are working on a pretextual foundation to try to fire Jay Powell for cause, talking about cost overruns on the construction of the Fed building. I want to quote word for word when the House Financial Services Subcommittee, I believe it was Maxine Waters, a member of the committee a couple years ago, asked Chairman Powell, will you leave your term early? And he said, wondering if he was going to give in to political pressure to go. And he said, I will never, ever, ever leave this job voluntarily until my term ends under any circumstances, none whatsoever. You will not see me getting in the lifeboat. So are they doing this to jawbone them into a rate cut? Are they doing this to jawbone them into resignation? Or are they doing this to set up a termination? I say all this as someone who is actually in agreement with the White House that Chairman Powell should be cutting rates, that they are unnecessarily tightening in their present posture. But with that said, I would consider it very disruptive to markets if such a pretextual and laughable, situation was used to force out Chairman Powell, undermining Fed independence. Oil was down 2% on the day, and then somebody had responded to the Friday Dividend Cafe, in which I say I favored the tax cuts from 2017 being extended. They were primarily at their largest level of impact, middle class tax cuts, and that to have seen a couple $1 trillion tax increase go into effect at the end of the year would surely have been recessionary. And someone said, okay, well, that's fine, but if you're so concerned about the national debt, wouldn't a recession be a good thing, a small price to pay, even if it lasted a few years, to deal with the national debt? And my response was, can you give me any example at all where a recession caused revenue to Treasury to increase? And if we're going to be a little more realistic about it, can you give me any example at all where a recession didn't create more public demand for greater governmental spending? Isn't that been the Keynesian way for almost 100 years? Can you give me any example at all where a recession created higher trendline growth that results in sustained revenues needed to deal with governmental debt? I just don't agree that the problem with the debt issue that I am so upset about is the revenue. The revenue as a percentage of GDP has stayed flat for quite some time. Spending as a percentage of GDP has moved higher and higher and higher. So there's two sides to it, a revenue and a spending side, but the part that has moved higher is the spending. The part that has not moved lower is the revenue. It's stayed constant as a percentage of GDP. The revenue to government has grown as GDP has grown. So I continue to believe that we have a growth issue we have to focus on, and that by utilizing tax cuts to try to get more revenue, but undermining growth would be a terribly misguided policy idea. So I appreciated that question to ask TBG, as I appreciate all your questions, and we'll leave it there. Okay, so very special Dividend Cafe coming on Friday. Required me reading 3 different books on the same topic this summer. And with those books done, I'm ready to write this. I'm going to leave you in suspense on the topic, but let's just say it will be a blast from the past. Earnings season is here, starting tomorrow. Get ready. I know we are ready here at the Bahnsen Group. Thanks so much for listening. Thanks so much for watching. Thank you so much for reading the Dividend Cafe.